Hello, this is LaShonda Stevens with L. Stevens Financial Services, and I'm back with some more info. Hello, my name is LaShonda Stevens, and I'm in the financial services industry. What is financial services, you may ask? Where there is no business in this country, or in the world actually, where you do not handle financial services or you do not deal with financial services. Financial services can be anywhere from banking to insurance. Primarily, I'm going to talk about insurance. So there are different types of insurance, and we'll get into that a little bit later, but I want to first give an explanation or information on why did I join this business. Well, I actually have a full-time job where I'm a medical billing and coding specialist. And in that business, I've learned that there are people that do not understand insurance. Specifically, in my business, in my day job, the industry is health insurance. And what I've learned is that there are people that don't understand key things about insurance. They don't understand how much insurance they have. They don't understand how insurance works. They don't understand specific terms like deductibles and co-pays and co-insurance and premiums. So I decided that I wanted to get in this business to educate and inform about the business of insurance. So why is insurance important? Insurance is important because it could be the difference between life and death. It can be the difference between being poor or being rich, or just having the ability to take care of your family. That's why insurance is important. So we're going to talk about what insurance is and give you some brief high-level definitions or vocabulary words. We call them industry vernacular to help you determine or understand and know what insurance is. There are many different types of insurance. I'm going to focus on three major types of insurance or common types of insurance. Specifically, I'm going to go more into life insurance, but I just wanted to give a high-level explanation of what the common types of insurance are. First, which is what I'm going to delve in more, is life insurance. The second is health insurance, and then you could also have property and casualty insurance. Property and casualty insurance are things like car insurance, homeowners insurance, renters insurance. Those are property and casualty insurance. And I am a licensed insurance agent. I'm a licensed insurance producer. We'll get into what that means and how that affects the business. But life insurance is insurance in general is just an assessment of risk. So the insurance companies have actuaries that determine how long a person might live, whether they're female or male, how old they are, what are their medical conditions, what kind of medications they may be taking, and that will determine how long that person is expected to live. And because of that, and because they do that, they can assess the risk that an insurance company, a carrier or a payer, so to speak, would have for insuring a person. And essentially how life insurance works is you purchase a face amount of life insurance and you pay your premiums, whether that's a lump sum, monthly, quarterly, or yearly. And if something happens to you, if you pass away, and in certain circumstances, or you become terminally or chronically ill, your insurance company will pay out. They will pay to your beneficiary, or if you're still alive and it's a chronic or terminally ill situation, you will get the money, but your beneficiary gets the face amount after you pass away. This is important because if you're the person who's the breadwinner of your home and that person is primarily taking care of everything in the household, they're paying the mortgage, or even if they're just paying half of it, if that person passes away, you lose half of your ability to pay your mortgage. You lose half of your ability to pay your car payments and all of the things. So life insurance is a tool to build wealth. Life insurance is a tool to build generational wealth. Basically, there are two types of insurance. Either it's whole life or term insurance. Whole life is exactly what it is. You pay it for your whole life. It is permanent insurance. So whenever you take it out, as long as you're paying your premiums, you have it for your whole life or age 99. Term insurance is the other type of insurance, and it is temporary insurance. All of the different financial gurus will tell you that they think term insurance is the better one, but you can make the decision for yourself which is better for you, whole life or term insurance. Basically, term insurance is you have the insurance for a specified amount of time. So you may have a plan that covers you for 5 years, 10 years, 20 years, and even 35 years. And then at the end of that term, you renew it, just like car insurance. So at the end of the year, you want to keep your insurance with Nationwide, you would just renew it. Now with life insurance, that is important because in 35 years, you're 35 years older. And so your premium may change and different things may change in order, or your ability to even be eligible for insurance may change as well. So there are pros and cons to whole life versus term insurance. That's why it's important to speak with a licensed insurance person or a licensed insurance agent, a licensed insurance producer to discuss your financial needs to determine which is better for you and your family. Depends on what your goals are. The other types of insurance I'm not going to get focused too much in, but just to give you some high level information, health insurance is for people who don't have insurance or want more insurance, and you go to the doctor, you can pay your co-pays, you might have a deductible, you might have co-insurance, and there also might be policy exclusions. It allows you to go to network physicians at a contracted rate. So when I say contracted rate, if something is $1,000 in general, the insurance companies may negotiate with the provider to accept $800 versus $1,000. So being a member of a specific insurance company, subscribing to that insurance, being the subscriber, it allows you to access care at a discounted rate, essentially. So that's kind of like what health insurance is. And there are many different types. You can have individual plans where you can purchase those directly from the insurance company like State Farm or Nationwide or whatever the insurance company is. But there are also employer group plans where if you are working for an employer, let's say you work for Google, and Google wants to insure its employees. Google may contract with Blue Cross Blue Shield, for instance, to insure its employees. And so when you come into the insurance or you get hired to Google, then you become eligible to participate in the Blue Cross Blue Shield plan that is an employer group plan through Google. So that's health insurance. You also would have property and casualty, which that's pretty straightforward. It's homeowners insurance. When you buy a home, you need homeowners insurance in the event of different things happening. There's flood insurance and things like that that might be included in homeowners insurance. Car insurance, everybody has to have car insurance. So car insurance policies are term policies, so you might have it for 6 months, 9 months, a year, depends on how your policy is written. Also renter's insurance, so you don't have to be a homeowner to be able to protect your property. You can still have renter's insurance, which would protect your property inside of your apartment in the event of theft, flood, and things like that. So those are the 3 common types of insurance: life insurance, health insurance, and property and casualty insurance. So now I want to talk about different vocabulary words or industry vernacular in relation to insurance. And again, this is high level. So this is very broad, very high level. This is not in detail. The first definition or term that I want to talk about is face amount. Face amount is primarily and generally associated with life insurance. And when you say face amount, you're talking about the amount of coverage. So if you wanted to get some coverage for your spouse and you said, I want a $50,000 policy or a $100,000 policy, $50,000 or $100,000 would be called the face amount of the policy. The next term that I want to discuss is premium. I believe everybody knows about premiums because this is what we primarily pay. Premiums are associated with all different types of life insurance. That is the business. The business is you pay the insurance company a premium and they cover you, or they pay to a provider, to a company for that service. So if you pass away and you have a policy, the insurance company will pay your beneficiary. If you have flood insurance and you have a flood, then your insurance company would pay the bills associated with the damage associated with your flood. That's how insurance works. So your premium is super important. You cannot have insurance without a premium. Now, premium is paid in several different ways. You can have a premium that is 100% paid by someone else, like there are employer groups that pay 100% of the premiums for their employees, and so a lot of employees think, oh, I don't have a premium. It is zero cost to you, but your employer is paying 100% of the premium to the insurance company. There's also, you can pay premiums in a lump sum. So if you have a goal that you have in mind and you want to take out a specific type of insurance and you have a lump sum of money, the best thing to do is just pay it all at once, and then you're covered for that term or for a lifetime, depending on what type of insurance it is. A lot of us pay premiums on a monthly basis, or a quarterly basis, or a yearly basis, but the most common is probably paying your premium on a monthly basis. I will say that you will save money the least amount of times you having to pay. So if you pay in a lump sum, that's going to be cheaper than paying on a monthly basis. Paying yearly is cheaper than quarterly. Paying quarterly is cheaper than paying monthly. A lot of the insurance companies will give you a discount or a break in the cost of the premium if you pay it up front and as much as possible. So that's what a premium is. It's the amount of money that you pay to the insurance company for them to cover you for a specific thing, whether it's life insurance, health insurance, or property and casualty insurance. The next term I want to discuss is deductibles. A lot of us are familiar with deductibles. Deductibles are associated with health insurance as well as property and casualty insurance. So if you have car insurance and you get into an accident and you want your insurance company to pay for your rental, you want them to pay for your car or pay your car off or pay for the other person's car, before they will do that, they will apply a deductible. A deductible is an amount of money, usually a flat fee, that you have to pay before your insurance will kick in and pay. In the healthcare industry, you may have a $500 deductible before your health insurance, let's say Blue Cross Blue Shield. Before Blue Cross Blue Shield will kick in and cover your health bill. So you go to the doctor, you have an MRI or a mammogram done. Before your insurance company will pay whatever percentage they have outlined to you in your summary of benefits, they will apply a $500 deductible to that if the charge for that MRI or mammogram is more than $500. If it's less than, then they will apply probably the whole amount towards your deductible and they won't pay anything on the bill. Again, this is a high-level conversation about these terms. So the next two terms are within the same industry, and that is health insurance. These terms are co-pays and co-insurance. I'm pretty sure everybody knows what a co-pay is because when you go to the doctor, your regular doctor, your primary care physician, you may have to pay a $20 co-pay or a $25 co-pay, or some people pay $5 co-pays or $15 co-pays. I think with even Medicaid, which is a government insurance, some people pay $3 co-pays. Whatever that flat fee amount is that you pay when you go to your regular doctor, that's called a co-pay. There are co-pays associated with other types of doctors, specialists, and things like that, but a co-pay is generally just an amount that you pay at the time of service for a specific type of service, depending on who the doctor is. Co-insurance is one of those things that a lot of people are very unfamiliar with. So co-insurance is the amount that you pay in addition to your insurance company. For the large majority of claims and services, your insurance company will pay between 80 and 90%. That is the standard. So if the insurance company is only paying 80% or paying 90%, there's an additional percentage that the member, the insured person, the subscriber is responsible for paying. And that is called your co-insurance. So when your insurance pays at 80%, the remaining 20% is called your co-insurance. A lot of people are confused when they get additional bills after they have paid their deductible and they paid their co-pays, and they think, why am I getting this additional bill? It is because your insurance company does not pay at 100% for this particular service. Your insurance company is paying at 80%, the 20% is your responsibility, and that is called co-insurance. Another term that people don't realize that is something that is your responsibility are policy exclusions. There are certain circumstances, certain instances, certain things that your insurance company will not cover. Usually, and most of the time, they will outline this in your summary of benefits or in the medical policy, which can be found on most insurance company websites. So you can find that. When you're signing up for insurance, most of the time they'll just give you a summary of benefits. But if you go to the actual insurance company website and pull up their medical policy, that'll give you a full list of the policy exclusions. So not only are you responsible for paying premiums, deductibles, co-pays, co-insurance, you are also responsible for anything that is listed as a policy exclusion. If a policy exclusion is aviation and you go and fly a plane, then you're responsible for any damage, any healthcare costs associated with you flying a plane. So now I want to talk with you about some industry terms that are specific to life insurance. And the first term that I'm going to talk about, or the next term that I'm going to talk about, are beneficiaries. What are beneficiaries? Beneficiaries are people to whom you leave money to. So if you have a life insurance policy, that life insurance policy is to pay out upon your death or upon you being terminally ill or chronically ill. It depends on what type of policy you have. So if you pass away, your beneficiary will get a check from the insurance company for the face amount of your coverage. The next term that I want to talk about are policy owners. Now, policy owner is a tricky thing because a lot of people think that if they have an insurance policy, it has to be on themselves. You can actually be a policy owner to someone else. So if I want to take out insurance on my husband, I am the policy owner. He is the insured. And we'll talk about what the insured is. The policy owner is the person who takes out the policy. It is the applicant. It is the person who essentially probably is going to pay for the insurance policy. So the insured or the proposed insured is a person who's covered under a life insurance policy. So in the previous example, when I said if I am taking out a policy on my husband, I'm considered the policy owner, but he is called the insured. That means if he passes away, whoever I list as the beneficiary is going to get the face amount of that life insurance policy. He is the insured person. He is the person that I want the insurance company to cover, to pay out to a specific beneficiary. One of the things to keep in mind as a policy owner is the person who also dictates who the beneficiaries are. So depending on what type of policy you have, depending on what riders are set on the policy, we're not going to get into riders, but just remember that word. Depending on what type of policy you have and the different riders that you may have on it, the policy owner gets to dictate who are the beneficiaries and if those beneficiaries are revocable or irrevocable. So the next term that I want to talk about is insurer, with an ER on the end. Insurer. Those are the insurance companies, the payers, the carriers. So depending on whether you have life insurance, health insurance, or property and casualty, it is a company that is going to pay out a certain dollar amount for a specific service. And so the last term that I want to talk about is agent or producer, and that is what I am. I am a licensed insurance agent, a licensed life insurance agent. And what I do is fit people with insurance companies. I don't work for the insurance company, but I can attach a person to a specific insurance policy with an insurance company depending on their financial needs. So what's next? More videos such as this, more educational tools, more informational sessions. Specifically, make sure you stay tuned for my lives on Instagram and YouTube, where I'll be answering questions. So yes, I'll have some Q&A sessions. So make sure that you're following me on Instagram at L. Stevens Financial Services, LLC. And I'm also on YouTube. So be sure to like, share, and subscribe to my channel. And don't forget to hit the bell so that you can be notified whenever I'm uploading the next video.